Quick disclaimer, I am not a financial advisor. I have basically zero financial knowledge. I am learning while I'm doing this. This is a personal log for myself and for your entertainment. So do not take this as stock advice. It is entertainment. So yes, this is a discussion of the strategy that I use, as well as a more in depth of how I put it in my Excel sheet. So the three indicators that I use, I have an EMA, two EMA lines, one short term and one long term. Short term I think is on like 9 or 7 days, and the other one is on 21. If you're going to use like IQ option, whatever the default is, just say okay, it'll be fine. Second one is a MACD one, which is a momentum indicator. Like, well, I just want to explain the EMA lines. They're just moving averages. So they take the average stock price, they take the stock price and they average them out over that time period. So the short term one is over that 7 day one, 7 day average, and the long term one is the stock price averaged out over 21 days. So that's what the moving average lines are. The second indicator is the MACD lines. That's just a momentum indicator. So when you have two lines, one is the MACD line, in this case the orange one, and the blue one here is the signal line. So when the signal line is above the MACD line, the stock price is going to go upwards. It's going to be a bullish experience. When the signal line is below the MACD line, it's going to be bearish. That's what that one shows. And then the stochastic oscillator oscillates between 100 and 0. When the oscillator is between 80 and 100, it is a bullish, it's going to go upwards. And when it's at the bottom, between 0 and 20, it is going downwards. And anywhere in between, it is a change of momentum. So, what is the strategy? How do I use these three? Firstly, you start with the oscillator. You have a look. Is it, so let's see, on the 5th of January, the trade is, the oscillator moves upwards. So it's maybe a turn of momentum. So you have a look. Okay, oscillator is going up, 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 up. And then while the oscillator is going up, you look at the MACD lines. Is the signal line above the MACD line? Yes, it is. It crossed over on the 6th of January. And then for final confirmation, is the short-term EMA line above the long-term? If it is, then you can enter the trade and buy. So it's going to go upwards. And then on the inverse, let's just have a look here for, yeah, this will work well. Let's say we were here, this is on the 21st of February of 2020. You go and you see, okay, stochastic oscillator is turning. It's going to go downwards. Then the EMA lines, there we go, we have a crossing. Signal line is below the MACD line. So then we look for the final confirmation of the EMA lines. The short term is below the long term. So that means it's going to go down. Then that means you can enter the trade. Now, how do you enter the trade? That's what I use my spreadsheet for. So Canopy Growth Corp is at the moment a stock that I am shorting, because look here, the stochastic oscillator is below, it's going to go downwards. The MACD line, look at that, the blue line is below the signal line is below the MACD line. And then right here, the short term is below, it crossed the long term. So it's going to go very much down, hopefully. Because as you can see here, Canopy, that's one that I bought. So how did it work? At the time when I entered the trade, my account value was $104,890. Virtual currency, that is not my money. I'm still experimenting as well, so I'm not going to put my own money into it. So yes, account value at purchase was that. Because I'm trading contracts of difference, I can use margin and leverage to increase the amount, kind of just increase my margin. So I use the max one at 5. People are scared of margin, but if you know how to use and know your risk, it might turn out for you very well. The entry price, according to eToro, or what eToro gave me when I entered it, was $33.93. So I entered that just as a raw number into the Excel. Stop loss is the recent lowest price, most recent lowest price, or highest, most recent highest or lowest price, depending on which way you are trading. So at that time it was $37.33 per contract. So that's the stop loss. Because I'm shorting it, I'm selling, so it's higher, of course. The potential loss per trade then is the entry price minus the stop loss, which gives you $3.4. That is the potential loss I have per contract. Like per contract I can trade. And the max loss, which is where was I? The potential loss max loss. That's where I was. So my max loss is my account value at the time of purchase divided by 100 times 3. Because I don't want to lose more than 3% if the trade goes wrong. 3% I think is a good thing, because I can go 15 trades into negative, like close them off, done, and still have more than 50% of my equity. That's just a good money management thing. So yes, that's my max loss I'm willing to take. The amount of CFDs, sort of contract, that I can trade is then my max loss divided by the potential loss, if that makes sense. So that gives me an amount of contracts that I'm allowed to trade for myself. And the trade value then is the CFD amount times the entry price. So that gives me a trade value. But because I trade on margin, I don't actually have to put in the total amount of the trade value, because eToro only allows me a max margin of 5. I divide the trade value by my margin times, which gives me an entry requirement. So the actual cash value I have to put into the trade is my entry requirement. If that doesn't make sense, watch it a few times. Hopefully it will. If it doesn't, I'll make another video explaining it. But yeah, and then the profit is just what the trade place, like eToro, tells me is my profit or loss I made on the trade if it closes the day. And then a profit or loss percentage, my notes, notes. And then, is the trade a good or bad? It was a good trade if I used if I followed my strategy good, like well enough. If I entered it, even though I maybe lost lost money, like on this, let's say this trade, on Visa cards. I entered a trade, it was a bad trade because it was the wrong candle time, so I instantly closed it and I lost $500. But like with BP, it was a good trade. I followed my strategy, but I lost money. But why is it a good trade? Because I followed my strategy. If I follow my strategy, eventually it will work out. Theoretically, it will work out and I will make money. So that's why the end goal is to make good trades, not to make money. And now let's just see. So let's say Canopy Growth Corp. I set an entry requirement of $6,280. Here I entered it. $6,280, 44 cents. At the moment, it is going not too well, but I entered it yesterday, so 20% down in one day might be bad, but it still hasn't hit my stop loss. So there's still so that now comes into play. When do I exit the trade? If it's negative, I exit it when it hits the stop loss, so the predetermined risk. Yeah, the stop loss. That's when I exit it, if it reaches my stop loss. Or when also do I exit it? When the indicators are gone. So if these things turn and the reasons for entering the trade is not there anymore, then you have to exit the trade. That is solid financial advice. If the reasons aren't there for why you entered, exit it. And then the moment it hits profit, the trade goes into the green, you set a new stop loss for you to break even. So if it goes into green, you set it as your entry price, and then as it moves up, as you start making money, you set up your stake profit. Actually, you'll set your stop loss higher and higher and higher until finally it turns and you get profit. You don't even have to look at it anymore. So yeah, that is the strategy in theory. In the next videos, I'll show you how I do it. There we go. Cheers.